Hello and a very warm welcome to this webinar, Understanding the Hidden Risks in Fibre Network Infrastructure Projects, brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator today. Now, as we all know, fibre is a relatively new infrastructure class, but a vital one as we head inexorably into the digital age. The projects are not homogeneous, and in general, European fibre projects have proven to be riskier than perhaps expected for investors seeking out the long-term stable cash flows promised by infrastructure. Now, to take you through the fascinating world of fibre today, I'm delighted to be joined by a fabulous panel. So let me introduce you to Marisa Fonenit, a project finance analyst at Scope Ratings, Jivan Singh Riate, a portfolio manager in infrastructure debt investing at HSBC Asset Management, and John Carey, head of infrastructure debt Europe at Legal and General Investment Management. So welcome to you all. Great to see you, and thanks for taking the time today.
Thank you.
Now, rather than taking through a long presentation, we thought it would be better to run the session as a kind of interactive discussion. Although I will ask Marisa to kick off with some brief top-line thoughts, just to set some context. And we do welcome your questions, so please do type these in as we go along, and we'll do our best to answer them. Now, today's slides will be available for download at the end of the session, and also available there will be the research note authored and published early this year by Marisa. I'll explain how to do both of those things later. So that's it from me. Let's get started. Marisa, it's my pleasure to hand over to you to make your few, brief starting comments. So the floor is yours.
Thank you, Keith. So first of all, welcome everybody to this webinar. Thank you for logging in. As you know, we're going to be discussing fiber network infrastructure projects, mainly in Europe, but thanks to Jivan and John today, we might have a bit of a UK-US perspective added to that. So just to kind of set the scene for this conversation, I want to take a kind of a step back and just think, what has kind of prompted all of these rollout projects. Obviously, it's the EU Digital Compass, which sets out specific goals of each European household having a minimum 1 gigabyte per second internet connection by 2030. And motivations for that are things like economic competitiveness, equality, social inclusion, etc. What's interesting is that every kind of EU member country has kind of taken a different approach in implementing these projects with differing results, which we can see in the following slides. So for example, let's look at the coverage rate. So Spain has, 92% of its country covered with fiber at the moment, and France has about 84%, whereas, countries like Austria and Germany are much lower at 40 and 42%. Similarly, take-up rates, which is obviously the number of customers who subscribe to fiber once it's made available, it's also quite high. And in Portugal, Spain, France at 78%. It's a bit lagging in Austria and Germany at 25%, Italy 27%, and the UK at 30%. Here we can see that since 2018, there's been a steady increase in the rollout of fiber all throughout the EU. We can see that even in 2018, France had a bit of a head start, probably because they launched their rollout plan, the Plan Très Haut Débit in 2013. And you can see now France has surpassed the EU average of 56%, and currently they're above 70%. And this last table here kind of neatly outlines some of the main structural features of the projects in these different countries. So you can see, for example, in France, they've taken a more concession-based approach, where they also benefit from significant government and regulatory support. They also have price controls. These projects include additional cash buffers in addition to a debt service reserve facility or account. They also have what's called a ramp-up reserve account, which helps during the ramp-up or early commercialization phase. And so therefore they, are able to have fully amortizing loans. And you can see that the coverage rates and take-up rates are quite high at 84 and 78%. On the other hand, you can see that in Austria and Germany, they have not opted for a concession-based approach, favoring a more market-based one. They have limited support from the government and from regulation with no price controls. Interestingly, they don't have ramp-up reserves, at least in the projects that we've looked at. They mainly rely on accordion facilities, and they also use bullet loans as their main funding structure, with kind of, I would say, weaker results with coverage, rates at 42%, and take-up rates at 25%. What's interesting is Italy has kind of used a hybrid approach where in certain regions, like the CD regions, they do benefit from concessions. The AB or more densely populated areas have a more market-based approach. They do benefit from some support from the government and from some regulations. They do have price controls. They have limited cash buffers. They also use accordion facilities. And they also use bullet loans for their funding structures. And you can see that their coverage is higher than in Germany and Austria at about 60%, but the take-up rates are equally lagging at 26.9%. So with that in mind, let's go and kick off this conversation. Back to you, Keith.
Great. Thank you very much for that, Marisa. And if you do refer back to the slides, let me know and we can bring it back up again. But let's, Jivan, I'm going to start with you, if I may. And so infrastructure has been out there and touted as a long-term, stable, uncorrelated asset class, very attractive to those that seek out those cash flows. But when it comes to digital infrastructure, and in particular fiber projects, it's a general question, but can you outline some key factors that you think determine kind of success for these projects in Europe?
Yeah, sure. So thank you, Keith. Thank you, Marisa, for the opportunity to have the conversation. So I'd perhaps start by agreeing with your first statement that there is no one-size-fits-all project financing, and I'd go one step further to say that there is really no one-size-fits-all fiber optic cable project financing. We've seen huge amounts of disparity, not only in the type of transaction that one can get involved with. You have long haul, you have last mile, full fiber to the home solutions. Within that, there are various revenue models. You have concession models, you have highly regulated single network rollouts, you have those which are essentially fully market driven. And even within jurisdictions within Europe, you see huge disparity in regulatory frameworks and incentives for operators to build out and for take-up rates. So it's quite difficult to pigeonhole exactly what makes a project successful and what doesn't. I think if you were, that's not me trying to avoid answering the question. What you have seen in parts of Europe which have been highly successful is firstly areas like France, which I'm sure we'll come onto in more detail, where there was an early, highly structured regulatory framework which essentially incentivized investment in more rural areas, which were initially deemed to be less favorable by private investment, but left the highly dense competitive areas open to the market. And that's not a guarantee for profitability, but we have seen that be highly successful. And then in some of the areas that you mentioned, Romania, Lithuania, Portugal, etc., where the cost per home passed is significantly lower than it may be in areas like Germany, Austria, the UK. Those have tended to be the two main factors in determining whether fiber rollout will be successful in a European, at least, jurisdiction. It becomes different when you compare the US, etc., but within Europe, I would say those are the main two.
Okay, John, it sounds like a bit of an investing nightmare with so much optionality in project structures and so many differences in government support, concessions versus market-based, etc. Can you perhaps pick up on what Jivan was saying, but also perhaps lay out some of the key risk factors that you see when you approach fiber projects in particular?
Yeah, I mean, I think the comments I'd add to Jivan's opening remarks really stem from understanding what your investors want. So the variety of the market opportunity set is not necessarily a negative if it indeed can be connected to investor preferences. And I guess we're mindful that there's a broad range of investors around the world that are interested in capital intensive infrastructure assets. So that opening remark, I think, frames how we look at it. We ask ourselves the question naturally, what are our current investors looking for? Does that connect or match what the opportunity is today? And or what does that connection look like in the future? And we're quite mindful that this is a subsector that is changing, and so deploying today is not necessarily the only answer. It might be that for certain types of investors, deploying at some point in the future is a more appropriate match. So we're very focused on timing. I think in terms of risk profile and risk factors, then I think what we've seen quite clearly, and I'll use the UK as a data point, is these assets aren't quite yet established infrastructure. They are very much a construction and build out enterprise in large cases. We've seen a variety of size in terms of the market operators. So that's another key risk dynamic in terms of scale. And that scale has, in our view, had a massive bearing on the cost efficiency of a given business in terms of its rollout business plan. It also, I think, has influenced the degree of success each business has had in terms of turning its physical infrastructure into hard earnings. Sometimes we like to frame that in terms of average revenue per user. So two big risk metrics that we're focused on is capital efficiency. In other words, the full cost to a business of connecting a home, not just the basic construction cost, but the fully loaded costs. And then secondly, the the customer penetration, and then thirdly, average revenue per user. And I think what we observe is quite a wide range of current positions in the UK market, which reflects the market design, which I think has more in common or more similar with the likes of Germany and Austria, and less so France. So hopefully that frames a little bit about where we're coming from. Clearly there is prospects for a classic infrastructure profile once we've hit stabilized stage, but at the moment we see this as quite a different dynamic playing through even in the larger concession frameworks like France.
Right. Okay, Marisa, before we move on, let me ask you just anything you want to add to any of that so far?
Yeah, I mean, I would say one thing to keep in mind is that there's clearly not one factor that kind of can ultimately determine success for a project. There's multiple factors, which can be complex sometimes. So besides scale, obviously, going back to what I was saying previously, governmental and regulatory support is key. So whether it's price controls or having a specific copper switch off date, and that is a key driver to a lot of these projects. I don't think it's strange that in Germany there is no copper switch off date, which I think plays into some of the projects where obviously in Spain and in France it's happening earlier. And also, the fact that in France they kind of de facto give a monopoly when they do these concessions. So there's no risk of like overbuild in the region. And then other things like capital and project structure, which we've started discussing. Timing of the rollout also. If the timing of the rollout happened kind of before the COVID-19 crisis, prior to all the issues with inflation and labor supply shortages, which all kind of happened subsequently. That's also been helpful. So, Spain and France started slightly earlier, so they missed that either partially or fully. And then also in terms of competing technologies, how present is 5G in the country where this project is taking place? Also, how is cable for countries like Germany, where there is no end site for a copper switch off? Cable plays a key role as a competitor, and also satellite. So there's actually multiple factors to keep in mind for these projects.
No, absolutely. I mean, we'll get to discuss some of those factors, particularly perhaps the satellite 5G topic. But just in terms of some of the benefits or advantages that fiber projects may have. Now, Jivan, my understanding, I'm no expert here, that's for you guys, but my understanding is that fiber projects can start to generate revenue before the whole project is fully built out, unlike, let's say, transportation networks or power. I think that's right. So, is that one of the benefits that you see? You can start the project companies can start to generate revenue before they've actually just fully built out the entire project.
Theoretically, it is. So if you were to compare fiber to the home rollouts versus traditional project finance infrastructure, like a power plant, for example, it has the advantage of you can start generating revenues as your network build out is going on. Whereas for most pieces of traditional infrastructure, you are limited to project completion before you can start realizing revenue. In practice, what we've seen from a lot of operators and sponsors is a willingness to recycle that capital into continuing their network rollout, because the grab for space is so important and so timely. So it doesn't always translate, though theoretically it is an advantage. In addition, the construction of a fiber rollout or fiber network is generally considered to be a lot more straightforward than a lot of traditional project finance. And so things like construction delays, cost overruns shouldn't be as impactful. That being said, on the flip side, you often don't have the benefit of a fixed price time certain EPC contract with a very large established contractor, and you're dealing with municipalities for local permits and local construction contractors who aren't as well incentivized always to get things done on time. So from a revenue perspective, there are some advantages. None of them are a guarantee, and all of them have their caveats. But on paper, there certainly are things which make fiber optic investment attractive versus other pieces of infrastructure.
Yeah. John, is that a tick in the box for you as well?
Well, the bit that I would add is perhaps more a reflection of businesses that are financing themselves as a corporate rather than a project. And what we see for those types of situations is, certainly in the last few years, a increase in the challenge they face to raise capital in order to pursue their business plan. And that, I think, we see in both the equity and the debt part of the capital structure. So yes, there are revenues being generated, but in terms of positive earnings, then a lot of these businesses are some years away, simply because of the need to continue to roll out, and indeed need to, on top of recycling what they have within the business, they need to raise additional capital. So the dilemma is a little different from a classic project finance structure. It's a little more fluid, and I think it does mean that in markets like we've had in the last 3 years, as rates have fundamentally shifted upwards and cost of capital with it, the capital raising element of the task is front and center, as much as some of the other risk factors we've already mentioned.
Okay, Marisa, in the paper that you wrote a short while ago, which I referenced earlier, you made the point that revenue shortfalls appear to increase with the size of the project. And the point you're making was the larger the project, the harder it is to understand underlying market dynamics. I was wondering if you could make some comments about that, and is that going to, is it already affect, or might it affect the way that projects are scoped out going forward?
Yeah, I mean, this is something, and kind of analyzing our underlying portfolio, we have noticed that in the larger deals, when I say larger, I'm saying millions of households being connected versus hundreds of thousands. The kind of take-up rates have tended to be often significantly off forecast, whereas for the smaller deals, which happen to be most often in France, they're normally, on target or almost on target. So, and I concluded from that simply by having a smaller project, especially for example in France, where these deals are structured on a department by department basis, you have greater granularity in terms of understanding the underlying customers, their digital preferences, what their needs are, what the kind of competing technologies are, how price sensitive they are, things like that. When you're looking at, a kind of multiple regions, you don't have that capability of really getting to that level of detail.
Yeah, indeed. And John, back to you for me on this one. I think it's picking up on things you said. I mean, there's a construction aspect of a fibre project, but then there's a bit of getting it to the home. So it's what are the adoption levels going to be by households? What are the subscription take-up rates going to be beyond the geographical factors that Marisa mentioned, where some projects have exclusivity for geography, others it's more competitive. I was wondering if you could talk about how you factor those elements in terms of what the expected future take-up or adoption might be. I mean, which is notoriously high, I suspect.
Yeah, happy to kick that one off. I mean, it's a challenging area for sure to understand consumer behaviour. We can obviously look back and think about the past and the present, but certainly a challenge around how it will develop in the future, and where indeed we land with respect to penetration rates and average revenue per user. I would say a few things though. One, we see businesses working a hell of a lot harder to understand this now than perhaps they were. So I think we have shifted somewhat into, yes, there's still rollout to do, and CapEx is a big part of that. But we have shifted, I think, quite notably towards an operational business, which is really trying to understand consumer drivers. And some of that is about understanding how much use. Some of that is about acquisition of customers. So what kind of churn rate might we expect to experience? And ultimately the flip side of that churn, which is, can individual businesses, fibre companies, actually move customers from their rival to their own network? That is something that is really a developing theme in areas where you have more than one provider to choose from. So I think that's an element. The other one is cost, which Marisa mentioned in terms of markets with or without price control. The UK doesn't presently have price control. There are, I think, some prospects for longer term there being some degree of price framework, but for now, not really. And we see a very wide range in cost of packages, depending on where and depending on speed. So that's another dilemma and another credit factor to analyse for us as to, well, where do we think this is going to settle once you've got a bit more of a stabilised market? So I think those are certainly some reflections on the consumer side of it. I think in the end, the other one that I'll add, and as a segue into Javan, but is the affordability dilemma. Mm-hmm. So right now, consumers are under pressure, and whilst the industry at large does like to call fibre the fourth utility, we do spend a bit of time thinking about the influence of the cost of living crisis and ultimately what is affordable for different types of homes.
Yeah, indeed. Jivan, do you want to also pick up on this topic? Because I think it's a fascinating aspect of how you view projects in terms of what take-up rates, etc. might be. I think that's a hard one, but yeah.
Sure. So perhaps I'll start by maybe just picking on something that Marisa said, and I agree largely with the premise that having kind of smaller projects allows you to be more granular, more expert in kind of local permitting, regulation, etc. However, on the flip side, and what you can see in things like City Fibre in the UK, for example, which has just turned EBITDA positive after a number of years, is penetration rates have taken longer to get to this kind of 30 to 40% magic number than expected. Costs have been higher than expected, and infrastructure lenders generally are not unaccustomed to things taking longer or being more costly than they were initially expected to be. But what's really important is how do sponsors and operators react to those challenges. One of the advantages of being a larger project with larger scale sponsors is you have perhaps more motivation and more financial backing to be able to withstand these kind of pressures. And usually that is the key question, is how do you fund the bridge between expectation and reality? So whilst there's definitely argument for being more granular and expert, there's certainly an argument for larger checkbooks being needed and more powerful to withstand periods where things don't go quite to expectation. Now to the other point, which was, please remind me, was that on penetration rates you were asking and affordability? Yeah. Okay. So again, I think it comes down to really what is the business case in every jurisdiction for the imperative for fibre rollout. As Marisa touched upon earlier, there are certain jurisdictions which have kind of copper turn-off dates, which means that these things have to happen by a certain date, and they will happen by that date. In places like the US, for example, where there is already a very high take-up of coaxial cable and not so much on copper and DSL, that there is less of a national imperative for there to be a full fibre rollout as fast as possible. And that's perhaps why we've seen less of a deal flow, at least from a kind of a limited recourse project financing perspective. So I think it's very location specific, and really what are the imperatives to get us from the status quo to 100% kind of fibre homes passed.
Yeah. Okay, Marisa, when you went through your presentations, you had a very interesting slide about some of the different structures across countries, and I wanted to ask you about the French concessions model. I know you've done a lot of credit work in that area. Can you talk about that? What are the benefits are? And how the financing mode in France perhaps differs, if it does.
Sure. As I kind of laid out in the article, France has kind of a long history using concessions for various projects. They started in the 19th century using concessions with private water companies, and subsequently they also had their famous road network, which was largely based on concessions. So it's probably not surprising that they actually decided to continue with that approach for such a large infrastructure project, which is, fiber rollout all over France. The positives of using a concession is that it involves a competitive tender, whereby you could argue that by having a competed out process, you have lower project costs, so arguably lower funding costs. Also, the authority grants a 25 to 35-year concession, so it's long-term to be able to, get a halfway decent return. But what's key in the French concessions, which you don't see elsewhere, is that they grant exclusivity for the region. So, as I said earlier, it's normally these are run on a departmental basis, so smaller. And the authority guarantees that whoever wants to sign up to fiber must go through this project company. So that already gives a very significant support for future revenues and project cash flows, which is obviously helpful to make these deals bankable. The other, I would say, item which is important to take note in kind of French concessions is also they're obviously using, project finance features, risk flow downs, various cash flow protections in their contractual documentation, having various reserve accounts, which, as I mentioned earlier, you don't necessarily see in some of the German and Italian deals. That plus, very importantly, subsidies, which the French government offers these deals, which once again helps to bring down funding costs. All that creates a very kind of supportive environment for these projects, which is why you can argue, French deals are typically investment grade bankable projects, which is not always the case in other countries.
Okay, John, Jivan, please feel free to talk about, did you both like the French model? Is it a sort of cleaner way of investing in terms of exclusivity around, or not? Or do you like perhaps sub-investment grade? If there are, I'm assuming you can get sub-investment grade riskier as well, but do you have any preferences for country at this point, either of you?
I think that's the right way to think about it. There's a variety of profiles, and then it's about finding the right fit. I think if you were looking to put longer dated investment grade capital to work, then there are definitely merits in the French concession model. I personally feel like being asked to take a view on the build out and market penetration is a reasonable proposition, and you're protected to a large extent from the overbuild risk, which in a market like the UK, you've effectively got to take a view on all of these. And I think it goes to Jivan's earlier point a moment ago that when you're left exposed to the full range of risks, e.g. the UK, then you start to look at scale operators with a little more interest on the basis that they should be able to navigate the long run in terms of rollout and then get to a stabilized profile. So I think it's it kind of depends. There is an opportunity for where it becomes more challenging, as you say, and on the sub-investment grade side, to invest at a higher risk and higher returning proposition. We have done that a bit for certain portfolios. When we do so, we're looking for something, though, that gives us some additional comfort around the defensive characteristics. So whether that be, in Marisa's earlier remark, a business that has an amount of subsidy, even if it's quite modest, that allows it to just have that extra edge from a defensive characteristic, aka barrier to entry. Another version could be a business that builds out according to a contract. So rather than speculative, at-risk capex, it's actually done under a contract. Those kinds of examples are where we would potentially take an overarching higher risk, higher return proposition through, but get some comfort from those additional features.
Yeah. Yvonne, do you want to add?
Yeah, look, I'd largely echo everything that John said with respect to France. It's conventional market wisdom now that's kind of the best model in Europe, though it's by no means perfect, right? There are French technology companies which have been experiencing trouble due to over leveraging, etc., and trying very desperately to get out of those holes. And I think the key is that kind of French regulators and government recognized very early that they needed to do something, whereas a lot of jurisdictions just kind of left it up to the market to sort themselves out. And in most cases, that hasn't worked as well as they would have hoped. I do also agree that there is certainly a market and should be an optionality for there being some element of demand risk, of capex risk, of build risk, and generally lenders are not averse to those things in entirety. But there has to be some sort of tangible mitigant to those things other than just saying we'll be able to charge a higher price. I agree, looking at kind of wholesale bundle purchases, for example, and you're building to a spec is a really good way. And the nice thing about that is that I've never had a conversation with a network operator who said that, oh, we're actually got too much high quality fiber infrastructure. There is still a real demand, and there's no doubt that bandwidth is needed to facilitate, the digitalization of our economy. It's just making sure that we do it in a way which is uniform enough and understandable enough by sponsors, operators, and lenders that the build out can happen efficiently.
Yeah, indeed. Actually, staying with you just on this, just a quick other question. I mean, projects I think you may have mentioned tend to be or are invariably exposed to construction delays, cost overruns, supply chain bottlenecks, labour shortages, particularly now, and other factors. By and large, have fibre projects kind of escaped those factors that can dog projects and have done over the years, or they could be being captured by some of the same issues?
I think they have, but in the same way that every greenfield asset class has experienced these issues as well. The two main ones for fibre rollout have been, as you mentioned, inflationary pressures, especially with respect to wages and labour costs. And the second being a higher interest rate environment, which obviously means that the amount of lending which can happen is perhaps reduced, or capacity to lend is reduced. Now, that being said, I think 2023 was slightly down on 2022, which was a record year in terms of non-recourse financings for fibre rollout, but not by much. So investor demand is still there. I think we all know that there is still a huge amount of capital needed, something like 150 billion euros just for Europe alone to try and get anywhere close to meeting the 1 gigabit goal by 2030. So it's one of those things that whilst there will be challenges, everyone knows that this has to happen and it will happen, and capital will continue to be deployed in the sector in spite of those challenges. Yeah,
absolutely. John, I mean, just pick up something that Marisa mentioned earlier, which I think is very particularly relevant here, which is, I mean, this is not a fibre-only world, right? In terms of technology out there. I mean, I think Marisa, you mentioned 5G and satellites and other things. I think you may have also mentioned, John. To what extent does the 5G world kind of interact or cross over with the fibre world, and does that make the landscape even more convoluted for you as an investor?
Yeah, I mean, it's fair to say that 5G and satellite alternatives does get a fair amount of discussion when we look at this sector. And I think it takes us back to that consumer behaviour point from earlier. It's quite tricky to project with confidence how different age demographic in terms of behaviour plays through in terms of the use of a fixed line broadband versus 5G, which is a little bit more mobile. I'm going to cop out and say I actually don't know, and I'm not sure it's knowable. I can point to a few things. Clearly, the rollout of 5G infrastructure is also slower than perhaps was projected some years ago. It's a significant amount of capital investment, and in quite a few cases, mobile operators are not in the greatest position to raise and source that capital. So I think that has slowed things. I think some of the factors that have affected fibre rollout in terms of access to labour and materials have also been relevant on the 5G side. So I think we're still probably a little bit way off really knowing how this is going to interact. I think the classic view is there's room for both, and the use case and the situation means that there's room for both. That's probably right. The question is, it takes us back to some of the risks we mentioned earlier about overbuild. If you're in a market where you've got some overbuild occurring, are you somewhat more exposed to the potential profile of 5G, even if that's in the future, versus, for example, an exclusive concession framework where you're not exposed to overbuild. So I think there are a few risks that might be stacking depending on where you are in Europe, and that might be one for us all to keep a closer eye. Whereas I think other situations have a bit more of a defensive profile and are probably slightly less exposed. I don't know, Javan, if you have any additional thoughts on the 5G conundrum.
Yeah, the only thing I would add to John's comments is how people view obsolescence risk. I think it's generally accepted that long haul fiber is going to be around for the next 20 to 25 years. And I think that's evident by the fact that certainly for dark fiber, generally the indefeasible rights of use or IRU contracts which govern lease capacity on those are typically structured as 20, sometimes 30-year contracts. So that gives you an impression of where network operators are hedging their bets as to kind of how fiber infrastructure is going to be important over the next 20 years. There isn't so much certainty when it comes to 5G infrastructure as to whether that's going to be around in the next 5 to 10 years. So I don't think that people feel there is going to be a huge disruptive technology which can do what fiber cable does currently. Now, the nature of disruptive technologies are they come up without much warning, so that may not be the case, but certainly currently I think the sentiment is fiber networks are more robustly positioned than things like cable and 5G.
Yeah. Before we move on from this topic, Marisa, I just want to give you the chance to add anything you might want to add on this aspect, if anything. And I mean, does that come into your world, as it were, as a credit analyst?
Yeah, I mean, we definitely do look at kind of the presence of 5G in the area. I'd say for French deals, most people haven't focused on it as much because 5G, the 5G rollout in France started later than in other countries. Having said that, I think we're now realizing that it should still definitely play a part in our analysis because the speeds that you get with 5G are still, solid. They kind of match the bottom end of what you can get with fiber, like 300 megabytes per second. And also, you don't normally have to have such a labor-intensive installation, which some people experience in France if you own a home. So it can be a lot simpler of a process to just sign up to 5G than to actually have fiber installed in your home. So for sure it should be taken into account. I mean, one thing I did highlight in my article is I didn't know if it was a direct cause or just coincidence, but I'd say it's partially both. In countries with an early 5G rollout like Austria and Germany, their take-up rates for fiber have been significantly lower. As I said earlier, there are a confluence of factors that kind of can lead to take-up rates, but I don't think we can ignore it either. I think if you've already signed up to 5G, you're happy with it, I don't see why you'll change, So I definitely do think it is one of many factors that one has to take into account.
Okay, indeed. Thanks. We probably need to close the session in a couple of minutes. So I just wanted to ask our viewers if they had any additional questions that they wanted to get in before we close. So we'll close in a couple of minutes. So if you have any final urgent questions, please feel free to ask them. Also, alternatively, just want to send me an email, k.mullin@scopegroup.com. I will circulate your question to the relevant person and get it answered that way. So before we close, I just wanted to ask just kind of open question to everyone in terms of, John and Jivan from the investor perspective and Marisa from your credit perspective. Is the expectation that digital generally and fiber perhaps more specifically will become larger parts of overall investment portfolios in the sort of medium term? Or are you comfortable with in terms of percentage-wise? Are you comfortable with your split now? I mean, Jivan, do you want to kick off and give us a forward view about your expectations for Fibre?
Sure. So I'll hesitate to put an exact number on it, but what I'll say is that we kind of were quite early adopters and felt that digital infrastructure was going to be an important part of our portfolio for a number of years now. So we've already kind of made a number of investments in the space, which have performed well, and I think we'll just see that continuing as we move forward. The deal flow is certainly getting larger and larger. We were just speaking before the webinar started that we tend to see one fibre to the home deal a month on average. So the deal flow is definitely getting stronger, and it's getting stronger from jurisdictions where previously we didn't see them. What we'd say to that, though, is it just allows us to be even more selective than we have been in choosing the right deals. And as John mentioned right at the start, deals which are commensurate with what our investors are requiring from us as well. So not necessarily to say that our exposure is going to go up, but we will continue to see it being an important part of our portfolios going forward.
Very good. Thank you. John?
Yeah, what I'd add to that is I can see by virtue of further maturity in the underlying assets, further consolidation in those markets like the UK where it is a little fragmented, I can see a picture developing where the businesses are larger, they are owned by long-term equity investors, institutional investors, where investment grade financing becomes more prevalent than it is today. I can see that. So in those portfolios that target that, I can see the exposure to fibre increasing. I think, however, for the meantime, there's a lot of opportunity in the sub-investment grade arena for those that are seeking higher returns. That may be investing at shorter, medium-term maturities, but I think that, to a large extent, is the 1 a month observation that I would certainly agree with from Jivan. The other bit, just linking into the broader digital sector, and this is, I think, one of where does debt capital come from? We're very mindful that these subsectors, fibre, data centres, etc., are incredibly capital intensive. And what excites us is that we think institutional debt capital has a major role to play in the arena. Banks continue to be vital, and that's not going to change. But we think we can offer something that is a little different, and in the broader sense of digital will be vital given the borrowing needs. So that gives us a lot of source for encouragement.
Very good, thank you. And Marisa, let me give you the last word. A closing statement. We've been speaking for a while now, and I think you've been kind of immersed in this for quite some time.
Sure, thank you. I think it's kind of clear through our conversation that it's actually a much more complex asset class than what I think investors had originally thought. There's many factors playing into every project, not only country specific, but project specific. And, given that it is a relatively recent asset class, everyone's kind of learning as it's coming along. So it'll make things interesting for when a lot of these deals are up for refinancing. I noticed in our portfolio, there's going to be quite a few deals, large deals having to be refinanced between 2028 and 2030. So I think it'll be interesting times, but I definitely echo what John said. I think this definitely plays an important role in any investor's portfolio, and I don't see that changing going forward.
Okay, let's leave it on a positive note. So let's close the session now. So thanks so much to Marisa, Jivan, and John for your great insights there, and thank you to our viewers for staying till the bitter end. I did promise I'd tell you how to download the documents. And so if you go to the bottom of your screen, you will see a button which says apps. If you click on apps, you'll see a handout pop out. Click on handouts, and then you'll see 2 documents there for download, which is Marisa's research note and the slides that she showed earlier at the very beginning of the session. So while you're doing that, we will be continuing to watch this sector very, very closely. We may indeed come back for another session at an appropriate time, perhaps later in the year or next year. But in the meantime, keep watching out for our research as it does emerge on our website. And we will be back soon. So that's it from us. So wish you all a very successful rest of the afternoon. Goodbye for now.
Great. Thank you, everybody.
Thank you.